Hello and welcome. Thanks for tuning in. This is KYC. Today we're going to be talking to a management which or rather a company which manufactures solar cells. It's an industry where there is some headwind but plenty of tailwind. Headwind with regard to tariffs, etc. That's currently providing or rather building up that uncertainty with regard to export. But just the tailwind is extremely strong. Really the question is, can that sustain? But I'll start off with why Premier Energies. It's a large 12,500 crore capex that they have lined up. Is there, and mind you, this is a 50,000 crore market cap company. This is a company with around 2,000 crore of cash currently. It does a top line of around 7,000 crore. Just kind of putting it in a nutshell, this is a large amount. Therefore, how are they planning to fund it? Will it be phased? And if I flip over to question 2 or point 2, is there a risk of cost overrun? This is what I want to know. Also, what I want to also understand is what the demand visibility and the order book looks like. The order book currently is at 8,000 crore. They're going to execute in 12 to 15 months. Can they therefore build out or continue to build out the kind of order book that they currently have? That's what I want to understand. Margins and price sustainability. Margins have expanded sharply. Can that sustain? And that can only sustain if price sustains. So some flavor around that. Strong competition, especially in the domestic market, going to come from fresh capacity. Foreign market already seeing very, very stiff competition, given the fact that there is the China factor which is playing out where solar modules is concerned. Why are they not pushing for export-led growth? Why aren't they competing better in markets abroad? Only 4% exports. Why aren't they doing that is what I would want to understand. Government-driven schemes, the risk of rising receivables is also the challenge. So therefore, why not do exports? And last one, what about transitions, technology transitions? How are they going to stay on top of it? TOPCon is one of the products which is the latest with regard to where solar module is concerned. I want to understand how are they staying ahead of the curve in terms of competition. But let's quickly understand about the company. It manufactures integrated solar cells and solar panels. The product portfolio includes solar cells, solar modules, EPC, as well as O&M solutions. The backward integration is at play. Backward integration into wafers and ingots. Some amount of perspective I will give as we roll forward where about the company is concerned. But this is the larger picture. Now let me start off by explaining what it is that solar cells actually is. So solar cells are made from wafers and ingots. So wafers and ingots are the raw material for solar cells, which is what Premier Energies manufactures. Thereafter, solar module manufacturing and then the finished product is manufactured. So that's the real value chain. These are just some of the products that are coming up on your screen. The P-type monofacial module. Now, I'll try and help you understand what each of those terms mean. P-type is more traditional. It's the older technology. Bifacial is where a panel has both sides which can generate solar electricity. When both sides can generate solar electricity, that's bifacial. When only one side is capable of generating electricity, that is monofacial. And therefore, what you will understand is a lot of these are products. TOPCon is obviously the latest product and the latest technology that there is. So it captures sunlight, that's what bifacial is, from both the front and the back. Monofacial is where the clear glass is spaced out, or rather monofacial is where the sunlight generates power only from the front side, not the back side. So that's the key difference with regard to product. In terms of the technology that's been evolving, I want to also cover very, very quickly only TOPCon. Let's try and cover that, guys. So, you know, what is TOPCon? I'm going to simplify this. It's a super efficient type of solar panel that's better than the older technology. The older technology was PERC. You saw that on your screen as well. But it's far better than PERC. How it works, it was designed through a special design which allows a tunnel oxide passivated contact, that it allows you to convert more sunlight into electricity than under the PERC technology. The benefits are, of course, you get the more juice or more electricity out of the same amount of sunlight that you are capturing. It has a better heat retention as well, so you lose lesser power, and it lasts longer. So you can keep producing close to its original power for a longer period of time. Mind you, some of these products last 30 years. So you want your product to last for a longer period of time. So this is currently the top product in its category globally, and Premier Energies is one of the manufacturers of it. Now let's also dive slightly into the kind of mix that Premier Energies actually has, and this is where it gets interesting. So they have an annual capacity, right? So this is the mix, domestic versus export. I did speak about it. Export is a very small part of the mix, right? The other piece is that the revenue mix, modules is 74%, cell is 23%, and then there's others, which is 3% of the revenue mix. But let's quickly look at the metrics, and I'll start off with the income statement, the balance sheet, the cash flow, the return ratios, the shareholding pattern, the street cred. There's no street coverage for now, but there's valuations and there's guidance that we'll delve into. Let me start off with the income statement, and if you're looking at the income statement, we haven't gone and extrapolated a CAGR number. That's because it may not exactly give the correct color going forward. So because your base was so small and the execution is so strong, just look at the top line growth from 1400 to 6500. EBITDA has gone from 78 crore to 1780 crore, and margins, which were 5%, are now sitting at 27%. Pricing, domestic tailwind, and execution, all three of that has led to the kind of numbers that you're seeing on your screen, but extremely strong. That is very, very evident. Look at your profitability as well. From a negative 16 crore, which is a loss of 16 crore, profitability has actually surged. Negative 8 crore in FY23, 289 crore in FY24, 1240 crore in FY25. And that is what is really impressive. The kind of late teens, or rather mid-teens kind of profit margin that the company is making, and the sustainability of that will really be the question. But a clear thumbs up, there's no doubt about that. The journey has been strong. Let's talk about the balance sheet now. And when you're looking at equity and other equity, which kind of helps you arrive at the book value, right? That book value number is inflated in FY25 because of the listing, of course. That's evident. And some amount of profitability also accruing, very, very strong profitability. We saw that in FY25. So those two are key contributors to that book value number. Now, the price to book on this one, wait for it, is 17 times. You have 2800 crore of book value. The stock market cap is 50,000 crore. So you want to take your eye out and keep your eye out and be careful with regard to this one. Look at the borrowing number, 1894 crore. It's ballooning. Capex is going up, and this will likely continue to balloon. And the good part is they still have cash of 2,000 crore sitting in the books. So I've given this a thumbs up because despite the borrowing sitting at 2,000 crore, you have cash also of 2,000 crore to offset that borrowing. So really the risk of any default is relatively better, and it does around 1,200 crore of profit as well. Sustainability of that, we'll have to wait and watch, but it does it nonetheless. So for the moment, we've given the balance sheet a thumbs up, despite the kind of debt to equity that this one is sitting at. But something to be careful about is the debt to equity. Mind you, just because we've given it a thumbs up doesn't mean you discount that. Let's look at cash flow from operations. Look at the way it's gone up again, 37, 90, 1300. And you look at the EBITDA and you look at the CFO to EBITDA, the numbers are distorted only because of the large receivables and the large inventory that the company sits on. We've given this a neutral. It's likely par for the course. It's just the way the industry works. Any industry or any company working with the government will face these issues. But at the same time, we're seeing it getting better now versus what it was in FY24. That being said, you should be cautious about this because the cash flow, again, isn't as high as one would like versus the EBITDA number that we are seeing. Let's look at return ratios now. And you see the way return ratios have zoomed. Sustainability of that is obviously in question, and a lot of that will depend on execution as well. A lot of that will depend also on capex. As the fresh capex comes on stream, you will see ROCE ratios dip a little bit, and thereafter maybe rise up again. So this will be something which will fluctuate. But what we have to give credit to the company for is the way in which they've managed it, at least over the last 3 to 4 years, which means that we've seen a surge. Can it sustain will obviously be the question that one asks. Let's look at the shareholding now, and nothing much to talk about where the shareholding is concerned, and I'll tell you why. Because what you really need to look for when it comes to shareholding is the fact that what does the promoter own. Now, you've got 3 to 4 quarters since listing, and therefore the promoter ownership has largely remained steady, and there's nothing much that I can say about that. But you look at FIIs, the holding has inched up. I don't have any names of specific FIIs, but they've inched up. And you look at DIIs, they too have inched up. You have the likes of an Axis Mutual Fund, a Quant, an SBI Life Insurance, a Motilal Oswal Mid Cap, a Kotak Mahindra Life Insurance, all of which have 1% or more stake in the company. So again, that's something to look out for. Let's quickly now look at street cred. Right? Let's quickly look at street cred. Since the IPO, you look at the way from the IPO price, of course, it's a fabulous rally that the stock has seen. It's doubled, more than doubled. But since listing price, not quite. We've been cautious about this. Good from a management standpoint. They've left enough money on the table for investors. That's a positive. But at the same time, is the return extremely good since the day of listing? Not quite. So again, something you want to look out for. We've been cautious. We've given this a neutral. Now, I want to also talk a little bit about street coverage, not quite, but about the guidance and about the guidance that the company has given. Let's pull out the guidance, and they've said that they will execute their order book in 12 to 15 months. They'll achieve 10 gigawatts of integrated capacity across ingots, wafers, cells, and modules. I described all of that to you by FY28. 2 gigawatt wafer plant. It's a JV with SAS Taiwan, and it's planned for commissioning in FY27. They're ready to invest around 1.2 gigawatt cell line in the US. They're awaiting policy clarity with regard to that. No solid guidance on margins, but hopes to maintain the margins that they're already doing. And they're doing backward integration. I did talk about that. But they're doing battery energy storage systems as well as inverter business. Both of those likely to be margin accretive going forward. So that is the big headline for me as well. That business could well also spur margins. But all of that and more. Let's lastly quickly look at valuations. Now, in terms of how this trades at, it trades at around 15 to 18, around 18 odd times 12 to 15 month forward EBITDA. We've extrapolated that. Valuations don't look comfortable. They look quite expensive. When I compare it with a Wari as well, the price to earnings for FY27, Wari trades at 21 times, Premier Energies trades at 30 times FY27. So you want to wait and watch with regard to this one, because it's certainly one of the more expensive ones, and compared to a Wari, it's expensive, and therefore we've given this a thumbs down, in fact, where valuations are concerned. It's run away. Can it execute at the kind of pace that they've guided, or even better, will be the question, and which will likely drive valuations as well. Quickly on to ratings. Let's sum it all up. Let's put it all together, and what you'll see is those are the first 4 factors, and then there are 4 more, but valuations is the thumbs down. The only thumbs down is valuation, something you should look out for. And what it gives you is a 5.5 on 8 on your KYC ratings. But we've asked all questions to management. Let's go across, speak straight with the management. We spoke to the Chief Business Officer of Premier Energies, Mr. Vinay Rustagi. Listen in to that entire conversation that Varsha and me had. Mr. Rustagi, let me first start off by understanding you've got a very large capex pipeline, much larger than the cash balances you currently have. Are the internal accruals that you're expecting that strong to be able to fund the kind of capex that you are expected to deliver? And give us perspective on cost overruns and the likelihood of that.
So I think, yes, I mean, that's a very good question. I mean, we obviously looked at all these things in terms of our financing plan over the next 3 years. So if you look at our last year's results, we declared cash from generation of something like 1,400 crores. And with the capacity increasing progressively over the next 3 years, the cash from operations is expected to increase year on year. So if we take that into account, plus the cash sitting on our books as of March, which was about 2,000 crores, we feel together with some incremental debt, we should be able to fund this entire capex without any additional need for equity funds.
Hi, Mr. Rustagi. This is Varsha here this side. Pleasure to have you.
Varsha.
Mr. Rustagi, now Premier's growth, or for that matter, any module and cell company's growth is highly leveraged to domestic policy. You have ALMM, you have DCR, or Kusum, or Suryaghar. How are you hedging against policy changes? Or the delay in scheme implementation, or the competitive pressure from Chinese companies if the global markets soften?
See, I think again, that's a very good question actually. And what we have to acknowledge here is that China is resorting to unprecedented dumping, not just in the solar sector, but in many other sectors of the economy, whether it is batteries, semiconductors, metals, fertilizers, and so on. And our assessment is that many other countries are now keen, including India, are now keen to grow their domestic manufacturing base. Irrespective of the kind of low prices that we see in China, solar is one of the critical sectors as far as the Indian economy is concerned. And the government has taken a very, very strong stance against imports and with a view to making India a truly self-sufficient nation over the next few years. I think in view of those things, we think the policy's risk to our business is actually minimal. The government is very, very proactive in terms of policy making. There's, in fact, I would say, a very structured thought process on how to start from the front end and then go to back end in terms of backward integration in a stage by stage phased manner. So the policy is very well thought out. One of the other things that we used to see in the sector is that there used to be a lot of policy changes if you look at the sector until about 2 to 3 years ago. But since then, based on the industry's feedback, based on the government's own learnings, the policy environment has become much more stable. There is a very active round of discussions going on within the industry, between the industry and the government. And hence we have a long-term policy clarity and visibility. So to that end, we don't see any kind of policy risk by way of any abrupt changes or withdrawal of any of the support measures. And indeed, I would say that we have a very, very long-term roadmap for India's solar sector manufacturing in India for domestically. And it's not just India, by the way. There are many other countries, US being one of the other prime examples, where the countries are saying that we can't be completely dependent on China, whether it is solar sector or any other sectors, and we have to find other alternate sources, including a domestic manufacturing base.
Sure.
So to that end, we are very comfortable with the current structure in the solar sector, and we feel that the risk of any abrupt changes or withdrawal of support measures is next to nil.
Okay. So one thing is competing in the global marketplace and possible insulation of that from a policy perspective. And the other is the fact that there's a fast growing capex push within this sector, even domestically. So what's the risk like with regard to both pricing as well as margins? Give us that perspective. Can this elevated pricing sustain?
No, so what is happening is, right now, I don't think you should look at the current trend in the market to be like a predictor of the long-term direction of the sector. The Indian solar sector is, I would say, the manufacturing sector is still in its infancy. We are currently at a stage where we are self-sufficient in module assembly, but we are quickly growing our cell manufacturing base. The next phase of the growth will be backward integration into ingots and wafers, and then subsequently into polysilicon. Just to give you an idea, India's cell capacity has grown from 5 gigawatts about 3 years ago to about 27 gigawatts today, and is expected to cross 50 gigawatts in the next 2 years. Our own capacities, if you see, we have come from 2 gigawatts of cells to 3 gigawatts right now, and we're going to 8 gigawatts, 8.4 gigawatts next year. So what is happening is that the scale of manufacturing in India is growing very, very rapidly. the entire ecosystem, whether it is aluminum frames, EVAs, back sheets, other chemicals, etc., everything is starting to be made in India. We are companies like ourselves, we are also integrating backwards. So with more scale, with more vertical integration, the costs will come down and they will be much more attractive pricing. And I would say even margins going forward for companies like us.
Can you just quantify on that margin front, sir? Because you have, I mean, you are doing backward integration and a lot of capex. I understand, for maybe 1-2 years may be difficult for you, but overall, over the next 3 to 4 years, what target you have when it comes to your EBITDA margin?
Yeah, so I think it is very difficult to give you a number in terms of the target that we have as a company. We don't give out any guidance also. But what I will say is that this is a very, very capital intensive business where the pace of change in terms of technology is particularly high. And the typical life cycle of an investment is between 3 to 5 years. So what that means is that every time we invest in a capacity, let's say for cells and modules, we need to recoup that investment in a period of less than 5 years and make enough return on it. And that means fundamentally it is a business where the return on capital employed should be somewhere in the region of 25% plus for a business to be strong, profitable, and keep investing going forward. So that is the kind of targets or the number that we will be aspiring for in the middle to long run.
Okay. So, point taken. I want to try and understand what the transitions to better product are like, and what are you doing in terms of staying ahead of the curve with regard to product?
Sure. So we see. In our core solar business, we are transitioning from the mono-PERC technology to TOPCon, which is the dominant global technology today. Gives much better efficiency, power output, etc. And more than 75% of our output from next year onwards will be in the form of TOPCon products. So that is one. Secondly, we are obviously backward integrating, which means we will start making our own ingots and wafers, reduce our reliance on imports, increase the share of domestic value addition. Third thing we are doing is that increasingly solar and storage will go hand in hand. Solar is a great technology. It is cheap. It is modular. It is environmentally friendly. It is very low risk. But it has a great limitation. The limitation being that it is only available in the daytime hour when the sun is shining. And that puts a lot of pressure on the grid. So really for solar to become a genuine 24/7 source of power, we need lots of battery and storage capacity, which means that when you can produce power in the daytime, you can store it and then also use it in the evening hours or the night hours.
Sure.
So there is a critical need for storage, and we've announced recently a plan to set up gigawatt hours of storage capacity, improving our product portfolio.
Okay. So in a rush, we're stretched for time, and therefore, very quickly, I'm going to wrap 2-3 questions into one. So, sir, the current execution of the order book is 12 to 15 months. What is the visibility on growth going forward? Why aren't you focusing on exports, especially since Indian contracts have a higher receivables, which is reflecting on your balance sheet? And where should margins lie net? Are you currently expecting the current margin to be sustainable and therefore ROEs to be sustainable? Sorry, I've wrapped all of this into one, but please give us a perspective.
Sure. Let me try my best. So I think number one, in terms of the demand outlook today is very, very strong. It is the best thing about the demand outlook is that the entire sector growth is very broad based. We are seeing very strong demand from the rooftop solar market, the agri solar market, the corporate market, and so on. And in fact, we expect a growth of 10 to 15% to be the norm, wherein the solar sector should start adding up about 50 to 60 gigawatts of capacity over the next 5 years on a per annum basis. So the demand outlook is very strong. In terms of the exports, see, I think India is very well placed in terms of exporting solar products worldwide. We are the only country outside of China which has got the kind of scale and vertical integration and the technical know-how to become a genuine alternative to China over a period of time. So there's a very attractive market outlook, particularly with many other countries now saying that we can't be completely beholden to China going forward. So in the short run, there is a little bit of an uncertainty, particularly because of the US market and the tariff decisions that are currently kind of pending. But as soon as these decisions are clarified and hopefully a trade treaty is signed between India and the US, we think that there will be a very attractive export market for our products over a very long period of time, because the cost of making solar modules in India is less than half of what it is in the US. So that is for the export market. In terms of margins, like we discussed already, currently we are enjoying good margins. I think with the market maturing and the capacity growing, there will be a little bit of moderation, but our expectation is that the margins will settle down, in a very attractive range, somewhere north of 25% in the 3 to 5 year period, which is still very attractive for us.
Completely out of time on this edition of KYC. Thank you for joining us. All of you viewers, stay tuned to NDTV Profit.